So the Federal Reserve has just revealed the fate of the United States, and I want to explain what is going on here, what we should look forward to in the future, and how this is going to potentially impact you and your money. So if you have any questions on any of this stuff, please ask your questions down in the comment section below. Also, I ask if you can spend just 2 seconds if you enjoy these daily uploads on how the economy is going to impact you and your money. Do me a favor, go ahead and hit that like button. But let's get right down to the information for today. First off, this is no surprise. You've probably seen the headlines. I did a video on it just this morning, and I said the U.S. inflation rate is now 5%. It's 5%. This is the lowest it's been in pretty much 2 years. This is good news. It's good news that inflation fell from 6% down to 5%. However, there are still some underlying problems, and the fact that we still have inflation, it's not going away. We are not going to see the target of 2% inflation within this year. It's just not going to happen. And if it does, it's going to mean a lot of heartache and a lot of pain for us here in the market. Now, here's something that is extremely important to understand. In the Federal Reserve's monthly minutes from last month, they said multiple times that due to the banking crisis, there is a good chance the U.S. ends up in a recession between the second and third quarter of 2023, or actually the third and fourth quarter of 2023. That means it's coming. But I want to read you exactly what they say. Look at this right here. So this is on page 6. It's an 11-page report. You can see right here. So these are the monthly minutes. But on page 6, and you can just scroll and find it. But right here, this is what I want to read you. Okay, we'll read this whole thing right here. For some time, the forecast for the U.S. economy prepared by the staff had featured subdued real GDP growth for this year and some softening in the labor market. Giving their assessment of the potential economic efforts of the recent banking sector developments, the staff's projection at the time of the March meeting included a mild recession starting later this year with a recovery over the subsequent 2 years. Now, here's the thing that a lot of people got hung up on, is that we're going to dip into a recession for 2 years? The answer is no. It would be a mild recession, but recovery would be for about 2 years. That's what you need to keep in mind. Let's keep reading about the recession. So in this entire report, the word recession is found 3 times. This is one time right here. This is a second time right here. And a third time right here. So let's read this one right here. If banking and financial conditions and their effects on macroeconomic conditions were to deteriorate more than assumed in the baseline, then the risks around the baseline would be skewed to the downside for both economic activity and inflation, particularly because historical recessions related to financial market problems tend to be more severe and persistent than average recessions. Again, if the recession is related to financial market problems, okay, right here, financial market problems, then there'd be more severe and persistent than an average recession. That's what they're saying. Now, why would they even bring up the word recession? Because again, in the previous monthly minutes, there wasn't a word about a recession. Okay, yes, they were understanding that a recession could be possible, but as far as that, were they planning for it? No. And so now that the Federal Reserve is planning on potentially being in a recession, well, that's something that we have to keep in mind. And this is why the markets are a little bit worried, because where do we go from here? Well, here's what is expected. The Federal Reserve is going to raise rates again, at least one more time, most likely by 25 basis points. And then, according to experts, we will see this prolonged pause. We're going to get to the 5% terminal funds rate. Okay, we're going to get that 5% terminal rate. We're going to stick there. It's not going to be for 1 month or 2 months. Chances are we'll be at that 5% for the foreseeable future. But why is this? Well, it's because right now a recession is still a worry, but a recession is not a bigger worry than prolonged inflation. We can't keep inflation at 5%. We need to see it go from 5% to 4.7 or 4.6, down to 4.1, down to 3.8 to 3.5, maybe into the low threes. That's what we need to see. Because if we see inflation slowly come down and we don't see big jumps where it drops, if we see it slowly come down, it's trending in the right direction nicely, and it would mean a soft landing. So we could potentially stay away from a recession. Again, a recession is not something that we want to get into, but the Federal Reserve will push us towards a recession if that means that we do not have high inflation. Now, here's something else. Right now, the Federal Reserve is likely to have a pause, and this is after one more rate hike, simply because they want to see how the markets and the economy reacts. They also want to ensure that wages don't spiral out of control, and if we see the Fed increase rates one more time by 25 basis points, get us from 4.75 up to 5, what they don't want to do is go in reverse course and lower rates. They want to keep them steady, pause for a little while, because at the same time, if we can ensure that wages don't spiral out of control and we don't have another crisis on our hands from the banking industry, well, that is a good sign. We even heard from billionaire investor Warren Buffett, and he said that he does not believe that banks are done failing, that there will be more failures amongst banks, and chances are they're going to come from the smaller banks, not the big boys, the smaller ones. Here's why. Right now we have a little bit of an issue. We have this commercial mortgage crisis. And why I call this a crisis and why many experts are calling it a crisis is simply because it is. What happens with commercial mortgages is they don't have a normal 30-year term like a regular home would. For commercial mortgages, let's say it's like a 10-year mortgage or a 15-year mortgage. But here's the difference. It's not just because your property's in a nice neighborhood does not mean it's going to be worth more. No. The way they determine is, what is the value? What is it bringing in? Are there tenants in the building? It's not, soon within the next 5 years, it's going to be worth a lot more because we have all this development going on around it. That's not the way commercial real estate works. So here's the problem. Many small banks got into commercial lending. They got in, they were lending money. Here's the problem. That bank, the owner of the building will then have to refinance. Okay? They're going to have to go refinance. And when they do, here's the problem. First off, rates are higher. And then the other problem is the building value itself is likely decreased. Why? Because of the past few years, more and more workers and businesses have been deciding to work from home. There's something called remote work. This is an incredible opportunity for people that don't want to work in an office building, but for the landlord, okay, for the banks who have and hold all these commercial mortgages. This is a problem because now they will not be paid. This is a huge, huge issue. And this is part of the reasons why Warren Buffett believes that we're not done seeing banks fail, because they will very soon. All right? Now, just understand, even though a bank fails, it doesn't mean your deposit is at risk. So don't go rushing out there and move your money from one bank to the other, because at this time, it's most likely not needed. Okay? Now, how do you prepare for a recession? I talk about this all the time, and I want to make sure that everybody knows preparing for a recession is different than just preparing for a small emergency, because a recession could potentially take 18 months. The average recession takes about 18 months. Okay, so keep that in mind. How could you get through 18 months of just rough times? Well, save some money. That would be the first thing I'd recommend. Save money. And you don't have to save millions of dollars. Okay, I always recommend you save 6 months as an emergency fund. And I know I've seen some of these videos, but people like Grant Cardone, who is big into real estate, he says never save money. That if you are saving money in a bank, it's stupid. If you are saving money because you want to make sure you have an emergency fund. That's dumb. Don't do that. Take all your money, invest into assets. And he's right. If you have a decent amount of money that you could actually live off of, okay? If you have a decent amount of, whether it's active income, whatever, and you're getting $10,000 a month, $20,000 a month, and you know it is coming, it's guaranteed it's going to be there, then yeah, saving money is not necessarily a good thing or a wise financial decision. But for the majority of people, especially here on this channel, if you don't have a $10,000, guaranteed passive income coming in every single month, then yes, save money. It's a smart move, and it's just very basic. Have something there so that if you need to buy food, if you need to pay for rent, if you need to put fuel in your vehicle, you can actually do that. That's the first thing. Second thing is to cut your expenses. This is different than paying down debt, because paying down debt, it's the next one. Cut your expenses. So if you're paying for Hulu, get rid of it if you don't watch it. Have HBO Max and you don't watch it, get rid of it. You pay for Amazon Prime but you never use it, get rid of it. If you have a gym membership and you go once a month, okay, that's it. Get rid of it. Why pay the $40, $50, $60, $70 a month to go one time when in most cases you can go down to that exact same gym, pay them $10 to $15, or sometimes just get a free workout in, and it doesn't cost you a thing. So again, cut your monthly expenses. The third way to prepare for a recession is to just pay down debt. If you have a credit card that is costing you, let's say, $400 a month, pay it down. So instead of $400, it costs you $300 or $200 or $100 a month. If you have a car payment, let's say your car is worth $20,000 and you owe $10,000 on it. Guess what? If you sold that car for even $17,000, you can pay off your debt, and you can take that $7,000, go buy another vehicle, and you would be debt free. How easy is that? Just a little quick tip for you guys. I've done it before in the past as well. My personal advice is to improve your skills. Okay? Have higher skills, that higher paying skills, and then it will increase your income. That's something that I recommend because it's something that's easy, anybody can do it, and you can improve on the skills that you actually want to improve on. If you want to be a better coder, learn to code. If you want to be better at marketing, read marketing books and take courses on marketing. It's a great thing to do. And again, marketing is a very, very important skill that many businesses would hire somebody if they know exactly what to do. The next thing is start prepping. One of the things I've always said is you need to be prepared. Be prepared for whatever may come. This means have extra food in your pantry, have stuff for survival just in case. Be prepared. Money set aside, right? These are all things that you can do. And even if you're worried about the dollar collapsing, don't have US dollars sitting in a bank account or in a safe. Maybe you have some gold and some silver and some other precious metals, because those two can be used to buy things and to trade. But that's what I wanted to fill you in on today, because the Federal Reserve just revealed what they are expecting here from the United States, and that is that we will end up in a recession between the third and fourth quarter of 2023. So again, that date is upon us. It's coming up very soon. When it does, we will know for sure whether or not we are in a recession. But as always, I will keep you up to date on everything that's going on. All I ask is if you can do two things, go ahead, hit that like button, click that subscribe button, and I will see you guys on the next one.